In this first episode of Superstocks, I want to highlight about the company which had been having a great movement of 103.28% on 8th of March 2021. The company is Second Sight Medical Products. It goes by the ticker name called EYES in NASDAQ. So imagine yourself having $100,000 and buying stocks of EYES, so you could just have another $100,000 having in profits. Isn't that crazy? Even if it gives an outstanding return, we must be careful whether we are trading or we are investing in the company. So basically, trading is for short term and investing is for a longer period of time. So we must be very careful looking at the aspect whether we need to trade for a day or two or really invest in the company looking at its fundamentals. You see, Second Sight Medical Products, together with its subsidiaries, develops, manufactures and markets implantable visual prosthetics that are intended to deliver artificial vision to blind individuals. Essentially, if you go to its website, it says it is recognized global leader in neuromodulation devices to treat blindness. The company leverages its 20 years of technology innovation to develop devices to treat the broadest population of sight-impaired people. It is inspired by personal connections with the Retinitis Pigmentosa diagnosis. If you didn't know about a diagnosis, there will be a link in the description below. The link is to a video which clearly will tell you about what the diagnosis is. Second Sight has researched, designed and created the world's first FDA and CE mark approved device for providing artificial vision in people with late-stage retinitis pigmentosa. About CE mark, there will be a link in the description below showing what it is. The company is actively developing a cortical stimulation device that bypasses the diseased eye and has the potential to provide a new form of vision to individuals blinded due to a wide range of causes. Second Sight was founded in 1998. In 2011, CE approval of first commercial implant was done, and in 2013, first FDA approval for first commercial implant was done. If you look at its risk analysis, earnings have declined by 3.8% per year over past 5 years. It makes less than $1 million in revenue. It is highly volatile share price over past 3 months. Shareholders have been diluted in the past year. Now we look at some market performance. Here are some shareholder return statistics. As you can see in this table that is having 30-day, 90-day, 1-year, 3-year, 5-year records, the shareholder returns vary significantly from the industry and the market. In the 30-day, ICE had 472% return, industry minus 7.1%, market minus 3.0%. In 90-day, 834.6% for ICE, industry 1.7%, market 7.2%. So we can see that EYES had an amazing return in the recent times. But if you go to the 5-year return, it had minus 62.8% versus industry of 130% and market 98.1%. So Second Sight hasn't had a good return in the long run, as we can see here by the minus 62.8%. Now to clearly understand this, we must look at the charts of EYES and see what's really going on. If we look at the candlesticks chart in the recent times, it tells us the prices have been steadily climbing. It had been climbing since November from less than $1, and in 8th of March it just skyrocketed and now it's at $15. Now if we look at the little bit of long-term view from 2015 onwards, price of this company had been around 112% in highs and suddenly it went below $1 during 2018-19, somewhere around there, and now it's trading at around $15. It is very mysterious why the prices had been climbing in the recent times. The company might be really speculative or it is really looking at its future. Now we look at price volatility of the company versus the market. Here we can see the industry volatility is lower than the average volatility and second highest volatility is very high. Now we come to price to earnings ratio. We can clearly see the price to earnings ratio of the market is 22.3, industry is 49.6 and Second Sight is minus 9.8. It is negative because it is unprofitable. Now if you look at price to book ratio, market is 2.7x, industry is 5.6 6x, and company that is second side is 602.7, which is very high in terms of valuation. So P/E ratio suggests EYES is really very much overvalued. Now we see the past earnings growth analysis. If you look at past 5 years annual earnings growth, market is 12.1%, industry is 15.2%, and company that is second side is -0.8%. But now let us look at the last 1 year earnings growth. Here market is 2.7%, industry is 14.2%, but the company gives us 55.7%, which is really very much higher what we could expect by looking at the past 5 year annual earnings growth. This can also be a very much of a reason where the share prices in recent times or recent months has jumped from $1 to around $15. Might be. Now we look at the ownership breakdown. General public has 54.1%, individual insiders has 27.2%, public companies has 15.7%, and institution has 3%. That is, we are talking about the percentage of shares which they are having in the company. Some of the top shareholders are Greg Williams, which accounts for 26.93% ownership, the Williams Company, that is, it has 15.67%, the Vanguard Group, which has 1.75%. You can also look at some investment firms like BlackRock having 0.17%. Overall, if we have to conclude, health is okay. I wouldn't say that really good. It gives no dividend and it is valued very high, and there isn't much previous history of this company. So it's very difficult to know what to say about the future looking at the number. It might be a futuristic company or a speculative company. So that is it. So what do you think about the company? Is it good for short-term trading considering the increase in price, or is it a stock for the long term? Put down your comments below. If you like this video, please leave a like, comment, subscribe, and make sure to hit the notification bell if you want to see my upcoming more videos. Thank you for watching. See you on the next video of Superstocks.